It looks like it's recording. And it is my great pleasure to introduce Dr. Ivan Milev. I hope I pronounced that right. A CFP, CPA, CMA. Dr. Ivan Milev got his CPA, CMA designation in 2015. Sorry. As a graduate of the Ontario CMA program. His background in engineering, physics. Sorry. Sorry about that. His background in engineering physics and his PhD studies made him a very analytical and creative person, and his diverse life and business experience in business development, investments, insurance, and taxation help him in creating solid and flexible total wealth plans. Ivan got his PhD from Sofia University in Bulgaria, and he founded several businesses working in Bulgaria and Germany. Ivan and his family moved to Canada in 2005. He speaks Bulgarian, Russian, German, and English, and volunteers for Chartered Professional Accountants Canada as a presenter for the Financial Literacy Program for the Financial Planners Canada, as an exam scorer, and serves as a board member of the Bell's Corner Business Investment Area. Ivan believes that finding the balance of life and career helps him be passionate in both. So at this point, I would love to turn it over to our expert, Ivan, and I'll let him take it away.
Thank you. Thank you for the nice presentation and for the short bio. It's my great pleasure to be here. Good evening, everyone. Great pleasure to be with you. This presentation hopefully will help the directors of non-for-profits, specifically non-financial, to understand better financial statements of the organization that you serve, which is one of the key duties of the board of directors to safeguard and the finances of the organization. And to provide effective oversight of the financial affairs of the organization by understanding financial statements. The non-for-profits use unique methodologies that are not found in the for-profit organizations, but they follow pretty similar accounting strategy, and there is some differences that I'll be talking about. So everything that I'm talking about today can be found in CPA Canada Guide to Financial Statements for non-for-profit organizations. Questions for director to ask. The resource slide later we'll see in the presentation. CPA Canada, we have about 1 hour together, and hopefully we finish on time. Please feel free to write questions during the presentation. If I'm not able immediately to answer some of them because of time scarcity or not be able to respond immediately for the specificity of the question, I have my email contact shared with the host, so you can communicate it to me and I can answer in writing later. So the session is designed to be interactive, and we'll have time at the end for questions. And for follow-up questions, of course, I'm open. I personally, as you see, sit on a board of directors like you, so I'm in a similar role. So the understanding the financial statement is important for me, and the board was lucky to have an accountant on the board, so that they can on every meeting they can ask questions, and I can share my experiences to clarify the things that we are wondering about. CPA Canada is standing for Chartered Professional Accountants Canada, and we work with numbers to help businesses be honest and successful. CPA Canada is one of the largest organizations in that kind in the world, representing over 220,000 CPAs across the country. But if you think of that number as too large, just it represents about 0.6 people in every 100 Canadians to be accountants. So it's not that much as a part of the society, and plays an important role. And some CPAs work in accounting firms, what everyone can imagine. some in non-for-profit, that like the organizations that you are in, and also like, for example, myself, I work in a investment management company, which is actually relevant to the profession because every single client and this time of the year is sending questions for personal taxes. Businesses raise questions for how the business investment should be structured, and we have long-term plan. We make long-term plans for being tax efficient and consistent and managing financial risks over long term. So that knowledge and experience that I have is very applicable, and my colleagues often come to me with questions. Clients often send questions that I reply to and help understand. Okay, so let's get started with the slides. Today's presentation is broadly about the board's role and the key accounting concepts and reporting. I won't read all the specifics of the outline, but these are the areas that we're going to be covering today. And I'll be talking about best practices, but I'll say that depending on the size on the nature of the organization that you serve, you might notice some differences. So with respect to fund accounting, for example, I'll be giving an overview. However, you'll find more details in the provided guide. It's a very good resource to get back to. So directors have a fiduciary duty or responsibility to act honestly and in good faith in the best interest of the organization. They also have duty of care that requires them to act with care, diligence, and skill that a reasonably prudent person would exercise in comparable circumstances. This obligation means you must diligently apply your skill, expertise, education, and intelligence to your role as a director to make reasonable business decisions. An understanding of financial statement and other financial information will help you in meeting your responsibilities. I love to use the word competency because you don't have to be an expert, but you need to acquire enough reasonable competency to understand financial statements and to go to the level of first level of analysis, let's say, of the financial statements and take conclusions and make decisions. So on the financial front, all directors have responsibility to take steps to ensure money or funds are spent in accordance with the criteria set out by the donor or the funder. Statutory obligations are fulfilled, for example, payroll deductions related to revenue conduct. Internal controls are in place to avoid fraudulent transactions within the organization. We often, of course, hear various reasons for some directors to minimize their involvement in the financial responsibilities. Like we have an experienced accountant on our board. In my case, why should I have to deal with this? Keep in mind that no one board member can abdicate or transfer their responsibility to another board member. Everyone has the same responsibility. And every board member must fulfill their obligation of the oversight of financial matters to the best of their ability. And you understand that we do not sit together all the time, so it might come to you to make a decision, and you have to understand the financial statement to be able to make the right decision. If you're fortunate to have an accountant on board, they can be a valuable resource and perhaps serve on the audit or finance committee. In my case, I don't serve on the audit, and we are a small board, so there is no committee. So every time we sit together. Should the board be focusing on our organization mission? Shouldn't the board be focusing on our organizational mission? Yes, a significant portion of the time should be spent on the mission and progress in achieving it. But financial matters are critical and risky because if the organization is not financially stable and secure, the board's efforts will be spent on survival of the organization. Accounting is just too complex for me. Accounting is complex. As a director, you don't need to be an expert. As I said, you need to have the competency and strive to have a basic understanding of the financial matter so that you understand what's going on if there is risk that needs to be addressed. You should be able to know enough to ask questions if something does not seem right. That's the best way of communication, to look at the picture and ask questions to check if you understand what it is and if you understand some risks to the organization in that area. Isn't this the job of the auditor or management? Definitely not, because there are three parties to the financial reporting, interacting parties: the board, the management or director, and the auditor. And each of them play different, important, and distinct role in ensuring fair and complete financial reporting for the organization. As I mentioned, all three parties have a crucial role. Think of a chair with three legs. If one leg is missing, the chair will not sit and will fall. Management, for example, has an intimate understanding of the organization's operations and finances in the everyday work. They create the financial information system to produce the financial reports, and they develop and implement the internal controls essential to the integrity of the finances of the organization, to integrity and reporting, and to minimize the risk of financial mismanagement or fraud. The board provides high-level strategic oversight, exercises due diligence in understanding and ensuring adherence to the internal policies and procedures and processes, and pays close attention to the internal controls to ensure they're working. Provides accountability to external stakeholders as well. The auditor, it has a key role to provide outside independent perspective of the financial affairs of the organization. They do not produce it, they oversee and give opinion and feedback. Provides an important check of the presentation of the financial information by management, examines the financial statement in accordance with the generally accepted accounting principles. Management needs to first produce the financial reports and for the other parties to be able to fulfill their roles. There needs to be a specific relationship between the board and the auditor. The audited financial statements provide a key measure of accountability and control for non-for-profit organizations. The choice of auditor is the responsibility of the board, not of the management, to select the auditor. In order to fulfill its fiduciary responsibilities, the board should require a meeting with the auditor without the management present in that meeting. And management should also be meeting with the board without the auditor, so that this way the three parties fulfill their obligations and are unobstructed and fair in the management of finances. Finance staff at the board collect or out of the board collect the appropriate data and information, manage the associated systems, and ultimately create the financial reports of the organization. And that might be external party like a bookkeeper firm or accountant. Managers in the organization are responsible for the financial integrity, risk, quality, program delivery, and other key internal roles who use these reports to perform their roles. Specific financial reports are sent to the board for review and oversight, which we'll talk about later in the presentation. And there is a cycle of financing reporting to the board. The budget typically is prepared before the year, like for the upcoming year, usually influenced by preceding year's budgets. The audited statement for the previous year are based on the auditor's report on the non-for-profit's financial statements. Internal in-year financial statements, interim statements that are prepared by the management, will report on actual results compared to the budget. And these reports will often include projected results to the end of the year so that the board and the management know where they are in performing and spending and collecting assets and cash. Calendar dates depend on the organization's fiscal year, because we know that it's not necessarily December 31st, but if it's December 31st year end, then the budget review would be in the fall, about 3 months in advance of the end of the year for the next year. Draft audited statements would be in the spring, about 3 months after the end of the year, financial year. And internal in-year reports, the interim reports, they likely be quarterly or semi-annually. On some organizations, depending on the needs and the size, might be even monthly. So financial reporting is also important to external stakeholders to the organization. A variety of stakeholders could have an interest in the finances. For example, the funding, like funders, government, foundations want assurances that the contributions that they make are being used with the subsequent approval. Donors want assurances that their contributions have been applied according to the wishes. Members have an interest in how their fees have been deployed and generally how the organization is performing. And Revenue Canada requires filing the included financial information basically annually. Common information required by the external parties is often met through the issuance of audited statements and the annual report, as simple as that. However, sometimes special purpose reports are required. For example, a specific funder, large funder, may require reporting specifically on the use of their funds. And this could often be a condition for the funding, for example. Okay, so let's go further. Now we're going to discuss some specifics of the financial reports that you can encounter. It's going to feel that it's a lot of information for the next part of the report for you to take all at one time, but please remember that the guide is there. So if it becomes too much, like take a break, have a glass of water, and I'm going to give information, but the guide is actually much more precise and accurate. And here I'd like to say that I found some discrepancies between the numbers that are on the presentation and the guide because it has been updated. And I believe that the presentation hasn't been updated after that update. So if you see some discrepancies in the numbers that I'm talking, please don't blame me as a bad accountant. I'm not a bad accountant. I can do mistakes, but I have the presentations and notes to it to help going through. But I found discrepancies between some of the numbers in that presentation statements and the updated guide. So follow the guide because it's very complete. But I'll give you all the idea of the relations between the statements and the numbers. Okay, so assets found on page 6-7 of the guide are found on the statement of financial position, or it used to be called balance sheet. And that's a snapshot. They are reflected at the point in time. Typically, that's the end of the year. Usually it's December 31st, but it's the end of the financial year for the organizations. So assets are distinguished between those are more liquid, current assets, in the form of cash or things that are expected to become cash before 12 months from the moment. Long-term assets, the second part of it, which are not expected to be turned out to cash in the current year. Let's say a car, some equipment, land, and property. The various asset categories, for example, property and equipment, depend on the chart of accounts set by the non-for-profit. And that chart of accounts should be consistent and followed year over year. And it should be ideally set in the beginning of the existence of the organization to serve the needs. Management develops and maintains the chart of accounts, categorizing the spending of the organization. The chart of accounts is reflected through all of the statements of the organization. Each chart of accounts will be different depending on the non-for-profit that you serve, and is specific for the organizations to better reflect its nature and needs. Liabilities.
We've got a question.
Sure.
They're asking if you could provide an example of what a cash equivalent would be.
Okay, so cash equivalent is something that is expected to be received in the next several months. For example, the organization might make a term deposit and it's not available because it's locked for 6 months, but it will be available in the 6 months. Or it could be a receivable that they expect to receive in 3 months, 4 months, 9 months, and it is expected to be receivable in cash. That's considered cash equivalent. It might not be immediately available, but it's expected reasonably to be available in cash soon, within 12 months.
Thank you.
Welcome. For example, the organization might need, let's say, 5,000 cash in the checking account to stay permanently, but they may have 50,000, and they may decide to make a ladder of term deposits, which come each month. That's an example of cash equivalent. Liabilities are also on the statement of financial position that used to be called balance sheet. And with the assets, they're separated in current and long term. And the liabilities that, let's say, a mortgage payment, monthly mortgage payment, will be current liability because every month it has to be paid. So the amount of the 12-month payments of a mortgage is considered current liability. The rest of the balance is considered long-term liability. The various categories of the liabilities also depend on the chart of the accounts. They could be separated in different groups in the chart of the accounts to serve the need. The revenues are amounts the organization records associated with increase in economic resources or cash related to the operating activity. Some example of revenues are listed here on the slide. Could be grants, contributions, sale of some goods that the organization has for one or other reason. And investment income like interest from a bank account is also such one. Expenditures or expenses also shown on the statement of operations. So we talked about first statement of financial position, which is a snapshot in one moment, typically December 31st. The statement of operations is about the 12 months between the previous balance sheet and the next balance sheet. That's the current year. So that accumulates for the 12 months. And of course, it could be interim, like monthly period of income and expenses. So that's called statement of operations. It used to be called statement of income and expenses, but now it's called state operations. They relate to amounts presented by the non-for-profit on the operating activities. Some example of expenses listed here on the slide, like salaries, rent, expenses, office supplies, and depreciation, which is a non-cash expense. Capital assets are deemed to have useful life, multiple years, with the cost spread over the useful life. And depreciation of a capital asset can be thought of the amount of capital asset used up in the period. That's, of course, it's an estimate. For example, a piece of equipment with useful life of 4 years was purchased for 100, and so you would reduce the value of the equipment by 25 each year. And that expense of 25 in the form of depreciation, which is not a cash flow, but it's an expense just by dividing portions of the asset value over several years of useful life. Net revenue is the difference between the total revenues recorded by the organization and the total expenses. Now, we're non-for-profit, so that has specifics. Typically, non-for-profits try to be as close to zero as possible in the net revenue. It's not possible to be zero most of the time, but close to zero. If the difference is positive, it's an operating surplus or excessive revenues over expenditures. If it's negative, it's called operating deficit or deficiency. By definition, it said being a non-for-profit, the objective would be to have net revenue close to zero. And how close to zero, what is good, what is bad? There is no hard rule, but let's say 1% of the annual revenue could be excessive, would be positive as at the end of the year. That's acceptable. If it's 50%, it's not acceptable because that's not the mission of a non-for-profit, typically to accumulate assets. Doesn't make sense. It has a mission to use the available assets in the best interest of the community or the organization or that they serve. We're not going to move into some details specific on the accounting that non-for-profits use. It is detailed and can be complex, but the presentation is to familiarize with some of the basic terminology and concepts that you may face, not intended teach you everything, but to have an understanding. And I would encourage you to follow up later on by reviewing the guide. In a time when you have questions, open it and you probably will see the answers there. And it's more comfortable at your convenient time, and you can sit down and look at a specific area of interest. Also, as the accountants on your board or management, you want to understand the specific in more detail. Contributions, should be on the page 8 or 9 in the guide, are unique revenue for non-for-profit, as they are non-reciprocal transfer, meaning that the contributor does not receive equivalency in exchange for the contribution. The donations, contributions can be a significant percentage of the organization's revenue, might be 100%. There are 3 types of contributions listed on here. Restricted contributions, where the donors specify how they want the funds to be used. That's called restricted. Endowment contribution, where the organization maintains the contribution intact, the principal, but may use the money earned on the contribution. So that becomes a fund, an invested fund that creates some income because it cannot serve that role by just staying in a bank account. And the third one, unrestricted contribution, where the organization can use the funds at the time and the way they deem best according to their mission. There is a requirement for non-for-profit to distinguish between the contributions and other revenues in their financial statement, because other revenues are not typical. They also need to separately track and report on various contributions that they receive. So that's automatic lighting here. There are 2 methods for accounting contributions. Each of them are valid. The deferral method and the deferral method and the restricted fund method. The non-for-profits typically chooses which method it will use when it starts to operate and contributions starts to come on a received. It could choose either method if receives externally restricted contributions, and must choose the deferral method if does not receive externally restricted contributions. Like internal restriction is a different thing, but if does not receive externally restricted, must choose the deferral method. You can alter the method, you can change it after if you find that it's not appropriate, but it's best to be set in the beginning because this is considered significant accounting change. It needs excessive notes on the balance sheet to support why this, and it has to be disclosed in the audited financial statements. It requires a restatement of the financial statement, which is quite a bit of work. Now, let me go through the deferral method for accounting for contributions. Generally speaking, contribution made is deferred in the statement of operations and counted in a category called deferred contributions, which is found on the liabilities section of the statement of financial position. It's a little bit confusing because it's in the liabilities. It's not really liability, but it's put there to balance the statement until those dollars are actually spent. When the dollars are spent, the contribution would be shown on the statement of operations as revenue. Even they are received before that as revenue, but because they are deferred, they should show at the moment they are spent at this method. Some of the accounting requirements under this method are listed here on the slide. Tracking on both contributions recorded and when related, when the expense occurs. Keeping track on capital and operational contributions separately. Separating out the amortization of contributed capital assets. Breaking out the types of contributions, restricted, endowment, unrestricted. Okay, we got more into the deep waters, so maybe you'll start feeling, I'll give you a little break, and to myself too. And maybe you can say also the more boring part of it when we get into multiple details. It's not necessarily everything to be understood in full and sunk as quickly as now. But let's go all these things, and if you have any questions in the meantime, please set a note, or you can ask at the end, or you can ask me after the end of the presentation and send an email later. So the restricted fund method that could be used for accounting for contributions. The important difference from the previous method and this is that for any restricted contributions, revenues are recognized immediately in the current year. There are no deferred contributions on the restricted method. For any non-restricted contributions, you would continue to use the deferral method, but restricted has to be recognized immediately. Under this method, the organization needs to have at least one restricted fund and a general fund. Once the restricted come in, you need to have a separate one. If an endowment contribution is received by the non-for-profit, they need to be an endowment fund as well, because it has to be followed that the principal is kept and the income only is used. So we talk about components of some financial reports you'll likely be asked to review. So let's talk a little bit about the reports themselves. Some accounting figures are based at the point in time, like in the statement of financial position. The others are for accumulation within a period of time, which is typically 12 months. The statement of operations, there is one on page 10 of the guide, is a summary of the revenues and expenses over a period of time. It also shows the net balance of the two, revenues minus expenses, so there is surplus or deficit. Statement of financial position, explained later on page 12, shows the various balances of the assets and liabilities at the point in time. The next statement, which is changes in net assets, provides the detail between the two to link those two. This details what has happened to the balance of the new assets over a period of time, usually the 12 months period. Statement of cash flows similarly focuses on the cash, how the organization generated, received, and used the cash. And all of these statements, they became 4 now, are related and they work together. For example, the year-end cash balance is at a point in time, is the result of the previous year cash balance and the result of all the transactions that contributed and used cash. Let's say you had 100,000 in the beginning of the year, you received 50, you spent 49, you have 101 end of the year. So they are linked and the equation has to be has to balance. Otherwise, there were some mistakes, some miswritings. Typically, boards will review the statement of operations and the statement of financial position at least quarterly. The statement of changes in net assets and the statement of cash flow are often reviewed as part of the audited financial statement. So it might not be actually for you. We're now going to move to some examples. Let's see some numbers. So as part of this example, that's very simplified, this example. So I'm going to outline some of the analysis that we could do and questions that might be asked, which is actually basically the job that has to be done. So that, I believe, is page 11 of the guide, but the numbers there are not the numbers shown. I just show you the example with the numbers. So this statement of operation is for the full year ended December 31st. And this non-for-profit has an operating surplus. It shows on the slide here 40K, which would likely be considered reasonable because I mentioned it's well under 1% of the total revenues. It's about 0.4 of the total revenues. So most of the money, 99.6%, have been used to achieve the mission. And recall that non-for-profit organization is expected to spend whatever revenues are generated. Here, I wanted to put a note here. I'm against spending the money in the last month just because we have to follow the mission. It has to be well planned in advance and to be used for the mission of an organization, not to be used to spend on certain materials just because we have to follow the rules. So plan well in advance, and the auditor will point some notes if they believe that there is issue with that percentages. However, a small operating surplus is not unreasonable to buffer against unforeseen events, and some organizations might need more. So it just has to be supported by evidence and needs. The current year surplus has fallen from the prior year. This is what part of the analysis start. And the expenses grew faster than the revenues. So this is the place where you can start asking questions, either to the accountant, to the management, and ask to explain, is that risky, or are we getting closer to the zero and utilizing our full balances for our mission? Okay, and is there any problem that needs to be addressed for the future year? That typically is discussion of the budget. From the guide on page 11, this NFP has a variety of revenue sources. However, it's heavily dependent on government funding, with almost 90% of the total revenue. You'll see on the guide, I'm not going to give you the number now, but about 90% of the revenue is coming from government in that example. So we need to understand how much of the revenue is coming from what sources. And if that changes year over year, that's the point of discussion. As the line amortization of deferred contributions, it shows the deferral method is being used to account for contributions. Looking at the expenses, like most non-for-profit, staffing costs are largest component of cost, about 80% of total expenses. Salaries and benefits grew year over year by about 5%, which of course we can relate to reality, let's say to the current year inflation, to the possible expenses needed for the next year, and to the amount of job done, and the amount of value contributed to the society or the community. So what is the relationship between amortization of capital assets and amortization of deferred contributions? About half of the non-for-profits capital assets are funded by deferred contributions. Current year versus previous year amortization of deferred contribution. You can see the examples, the amounts of the deferred capital assets being recognized in the current year. Okay, let's go to the statement of financial positions. That would be on page 13 to 15 of the guide. The statement is a snapshot in a point in time, typically December 31st. On this statement, the understandable formula is the net assets are equal to the total assets minus total liabilities. That's easy, understandable. Now, in the statement, it doesn't show, it shows a little bit rearranged. So on one of the columns is the net is the total assets. The other column has the same bottom line, and total assets is equal to the total liabilities plus the net assets. It's the same thing. It looks a little bit rearranged, but the logic behind it is very clear and simple. We can see that the total assets increased from the previous year by about 2%, which is pretty similar to the amount of increase of the net assets. Cash and cash equivalents in that example are about 57% of total assets, both in the current and previous year. And for many financials, the total assets actually might be small relatively to the revenue if they don't need to use long-term assets. And they might just utilize the revenue as it comes to do the operating activities. The principal amount of the mortgage given there was paid down by 8%, which is point for discussion. Looking at the deferred contributions, they increased by 40%. This reflects the additional funds for use in future. And deferred contribution minus capital assets represent these contributions to be matched by the amortization of the assets to be used in the future. So here are some tricks in the numbers game. The net assets of this non-for-profit have been broken into 4 categories: endowments, net investments, board designated funds for special projects, so that's external restrictions, and unrestricted, which is the largest. Okay, let's go to the next slide. That was just on top of the picture. On the statement of financial position, there is some additional analysis you can do, so that's specific to analyzing the current position of the non-for-profit. First, working capital, which is the difference between the current assets and the current liabilities. Looks a little bit business, but that's the difference between current assets and liabilities. In this case, the working capital for the current year is 2,190. Actually, in the example here might be a little bit different, but on the slide, you can follow those numbers on the slide. Compared to the prior year, where it was a little bit less, 2,125, which is an increase of 65,000 of the working capital. And that might have an explanation. This is where we start asking questions and think strategically of the next year and the budget. Working capital is usually a positive number, thought of as a short-term cushion available to the non-for-profit in the current year. A positive working capital balance is evidence of the organization's ability to pay its bills as they come through. And there is a ratio, working capital ratio, which describes how many dollars of current assets, cash or cash-like assets, are on hand on each dollar of current liabilities. It has to be more than one. For that non-for-profit, it's like 2,500 something versus 347, which is a decline from previous year of 8, but it's well over 1. So liquidity is excellent. The last thing a non-for-profit wants to be illiquid and fall into financial hardship. Ratio value of greater than 1 signals capacity to short-term to pay all the current liabilities without any question. And this non-for-profit has a substantial working capital cushion, which is good. Okay, let's go quickly to the next one. We're very deep now, not that far from the end of the presentation. How are we for time? 43 minutes. Okay, good. The next two statements are found in Appendix 1 on the guide, page 23, statements of changes in net assets. That's one of the following last two statements. We know categories are selected by the non-for-profit for net assets as they're shown on the statement of financial position. So the auditor, when they read, they know what is chosen to be represented. The invested in capital assets category has been chosen by that non-for-profit to report specifically. They have received endowment contributions and are therefore obliged to account for in a fund and disclose them separately. The board of this non-for-profit internally restricted amounts to be used for a certain purpose in the future, and that's reflected in the financial statement. The remainder is the unrestricted net assets. The end-of-year balances on this statement are identical to the balances of the statement of financial position. So this is how they link together. Things to note in these statements are the operating surplus contributed 52,000 to the unrestricted net assets. The board transferred 15,000 from the unrestricted net assets to an internally restricted fund for a special project. An endowment of 20,000 was received as income from fund invested. The details on the notes evidenced by asterisk show that values in the statement were calculated. How they are calculated. These notes are part of every statement and are necessary for its understanding. So please know that besides the numbers, there is notes on the bottom that help understanding and provide valuable information for the reader. The first note explains the deficiency of revenues over expenditure. It comes from deferred capital contribution, so it's actually artificial. And 24,000 of amortization comes from the statement of operations. And the second note explains the increased investment in capital assets comes from the 75,000 mortgage payment. So that's just interpretation of the numbers and the purchase of the 2,000 in capital assets. And you get these values from the statement of operations, and they're also shown on the statement of cash flow. Okay, let's go to the next slide. We're not far from the end. Page 26 or 27 of the guide, look at the statement of cash flows. It focuses exclusively on cash. How it's generated, received, and how it's used. Breaks down the flow of cash in 3 areas: operating, investing, and finance activities. The main, of course, is operating. The excess of cash needs to provide something, and especially if there is endowment, that's the investing. It could be significant if there is endowment. And finance activities, this is more about the cost of the doing business for that organization, like bank fees and stuff like that. This statement is important for directors to pay attention, as it ensures the organization has the appropriate liquidity and also guards against mismanagement or fraud. To put together this statement is not as simple as adding your operating surplus to the opening cash balance for 2 reasons. First, you have to adjust revenues and expenses for items that don't involve cash, like depreciation and amortization of the assets. You also have to account for investing and finance activities, which are external, like non-normal passive activities, I would say, not main activity, from the statement of financial position that use and generate cash. But those typically are smaller numbers. This statement is often the toughest for the director to decode, as they're both positive and negative entries that could be not very easy to follow exactly. So typically you can ask the accountant who is available to read more into those details and understand. And I did that similar thing recently for my manager, because something in the financial plan didn't look exactly correct, didn't match, and I myself needed to go to another expert with more experience and read it, and then get back to the director and explain why this doesn't look right, but it's actually right because there is other things related to it. So positive number adds to the cash balance, while negative number takes away from the cash balance. Positive entry 1 year can become a negative one in the next year. So this is one statement that could be explained by an accountant if you have one on your board, or alternatively ask the person in the management who put it together how they came to it. So fund accounting, you can find more details after page 28 of the guide. That's the endowment, when some funds need to produce income that could only be used. The tracking of externally restricted contributions and internally restricted net assets is important task of the management. You have to differentiate very distinct between them. Common method of doing is using fund accounting. Fund accounting is a choice for NFP and not obligatory, even if contributions are restricted. It's obligatory when there is endowment. Tracking restricted contributions, though, is obligatory. Fund accounting is the formal creation of individual funds. In other words, it's a pots of assets segregated for accounting purposes to be monitored separately, to not be mixed with the other in accounting. Non-for-profit may formally establish a number of funds reflecting the variety of restrictions placed on them and the variety of activities and projects that they manage. So they can do such funds based on either external or internal restrictions. You will notice that under fund accounting, there is no need for a separate statement of change in net assets, as the statement of operations shows the details for each of the identified funds. So that simplifies on the other side. We talked about the various audited financial statements that the auditor reviews, but didn't talk about the auditor's opinion, what it is. So the mandate of the auditor is to directly review the books and the records of organization and provide an important check on management. Recently, we got a note from the auditor for our budget for the next year, and it was funny, simple, and reasonable, that the auditor said, I don't feel that you spent enough time to discuss the plan for the next year, because I see nearly all items are increased by 5%. And this is not a good job. So it was a good point, because our organization used a subcontractor for bookkeeping, and we didn't have at the moment a permanent director, so the secretary gave that job to to the bookkeeping, and they just made it for me because they don't know the nature of the job. So we had to spend time and on email. I suggested certain things to be changed based on evidence, because when we talk about budgeting, we need to have specific things in mind, and we have to be reasonable. Like the inflation, for example, is 7%, not 5%, and we save some time. We save some money from time without a director. So I just gave idea how this ought to be reflected in numbers. So it's the best things is to ask someone with more experience to address such things when there is notes. The notes to the financial statement provide additional important information that could be found in the audited statements. They often help clarify or further explain items on the financial statements. They have the same significance as the actual statement, the notes of the auditor. Starting on page 35 of the guide, you can see some examples of the auditor's opinion. So they are different types. Unqualified, meaning they have not identified any concerns, or qualified, they have identified a concern. Most often for non-for-profit, a qualified opinion is due to auditors' inability to verify the cash donations. That's specifics. To conclude, the role of director in a non-for-profit is an important one, and you should be able to understand the financial statement, the basics of the financial statement, provide regular review of the financial information, including the budget for the coming year, with planning, internal financial statements that are done on purpose to track the year, the audited statements, and any special purpose reports. The guide that we have provided now provides examples of questions of directors, which is the most important part of the guide for me, because you really start thinking of when you see what questions the directors might wish to ask, to management about various financial reports, and to the auditor about the year-end audited statements. So this is really the role. And one final point to leave is keep asking questions until you're satisfied and you understand. There is nothing wrong with it. Actually, it's the best activity. You can download the guide at the cpacanada.ca/financial literacy publications. You can ask for that later on if you were not able to record it, or if you don't have space now to record it. So cpacanada.ca/financial literacy publications, one word. The guide includes a glossary of financial terms after page 40. And thank you for your time. So how much time we have questions? 6 minutes? Okay, open the floor for questions.
Okay, so you can either take yourself off mute and ask a question directly if you have one, or you can put it in the chat. Either one is totally acceptable. But in the meantime, while we're waiting for these questions, I have a question for you. So with a lot of non-for-profit organizations, sometimes they may be fundraising for a specific project. So the project may not take place in this fiscal year, it might take place next year. So is it okay if they carry that forward to the next year with an explanation stating, okay, we've got this excess in revenue of whatever, $40,000, but it's because we are doing this project, which is going to be expensed as of, say it's 40,000.
It's a very good question, and I would say absolutely yes, because the financial year is for us to understand what's happening, but we don't necessarily have to stick with the financial year with our activities because they change over time. We have to be flexible, and as long as there is a clear explanation on the annual financial statement, that's perfectly acceptable. There is no need for too much details. Simple and clear explanation of the reason why let's say this cash is available end of the year and it's not spent toward the mission, is enough. That probably is very important for smaller organizations, because in larger, such project might be a small portion of the whole activity, but in smaller, that could be like significant part of the activity.
That's right. Does anybody have any questions at this point? So I did email the guide out earlier. At any point, if you have questions, you didn't receive a copy of the guide, I'm going to put my email address in there as well. You can email me. Ivan's email is in there as well.
Thank you.
And we are both here. I hope that, I know it was a lot of information to pack into.
I would agree that it was overwhelming, even to me. I tried to fit it in the time, but
Yeah.
I just want to show that it's not wrong to ask questions, and there's nothing wrong. I also find new terms during that service. I've been already about 8 years with that non-for-profit, but I cannot say that I know all the terms in the financial statements, because they have been followed for years the same. But some of the, you know what, in each end of year statement, there is one large position which accountants use to make it balance. And when the experienced people can choose which position could be used for that reason, because they have to balance end of the year, and some differences have to be fixed by that one position, which is typically a large position that could not misrepresent.
We do have one question.
Sure.
So, and I don't know if you're going to be able to answer this or not. What is the average cost of an audit?
Oh, for us, for example, is $4,000. Our annual budget is about 140, and we pay $4,000 for an audit to Ernst & Young. And our reports are simple.
Yeah.
So they probably have a minimum. They probably have a minimum for even a simple. It's an organization. They have to put their signature. They have to do the due diligence. For larger would be more, but I don't know above what amount of revenue could start being more than 4,000.
Yep. And it depends on, like you said, Ivan, the complexity.
Yeah, exactly. The complexity. Yeah.
Yep. All right. Well, I will let everyone go. The weather is beautiful. We actually have summer today. Hopefully it sticks around. But again, I'd like to thank everyone for attending. I would like to thank Ivan very much. And yes, we will be sending the recording of this out probably tomorrow.
Thank you very much for attending. Thank you for your patience. 8 p.m. Central Time, 7 p.m. Eastern Time. And let's enjoy the weather this week, and hopefully we have more of it.